Imagine waking up tomorrow morning in Australia and discovering something unbelievable. No income tax. Gone. Your paycheck arrives and not a single dollar has been taken by the government. A worker earning $80,000 suddenly keeps thousands more every year. A doctor keeps tens of thousands more. A business owner smiles. Employees celebrate. Politicians claim they've delivered economic freedom. For a brief moment, it sounds like a dream. Then reality starts asking questions. Who's paying for the roads? Who's funding hospitals? Who's running schools? Who's protecting the borders? And perhaps the biggest question of all, if income tax disappears, where does the government get hundreds of billions of dollars? Because money didn't magically stop being needed. It simply stopped coming from one place. And what happens next is where things get interesting. Because removing income tax doesn't just change paychecks, it changes the entire country. To understand why, we first need to understand something strange. Most people think governments are funded by dozens of different taxes. But in Australia, income tax is one of the biggest money machines in the entire system. Every year, workers hand over a portion of their earnings. Not because they enjoy it, not because politicians are particularly persuasive, but because modern governments are expensive, very expensive. Roads, defense, healthcare, public services, infrastructure, emergency services. The list never ends. Think of a government as a giant operating system. Most people only notice it when something breaks, but it's quietly running in the background, all day, every day. Income tax is one of the main power sources keeping that system running. Now imagine pulling the plug. At first, people would celebrate. And honestly, who wouldn't? An employee earning $100,000 might suddenly keep many thousands more every year. Households would have extra money. Consumer spending would surge. Restaurants become busier. Retail stores sell more. Travel bookings jump. The economy initially feels stronger. Politicians would point at the numbers and say, "See? It worked." But this is where the story takes a turn. Because governments don't simply shrug when revenue disappears. They go looking for replacements. And that's where the uncomfortable math begins. Let's say income tax vanishes tomorrow. The government suddenly loses an enormous source of funding. Yet hospitals still need staff. Roads still need maintenance. Military personnel still expect salaries. The bills keep arriving. Only the money doesn't. So what are the options? Option 1. Cut spending. Sounds simple. Until you realize every budget line has people attached to it. Cut healthcare. People complain. Cut education. Families complain. Cut infrastructure. Businesses complain. Cut defense. Security experts complain. Everyone loves spending cuts in theory, just not the spending they personally use, which creates a political problem. The second option is more likely. Replace income tax with other taxes. And here's the irony. Many countries that advertise low income taxes often collect money somewhere else. Consumption taxes, property taxes, import taxes, resource taxes, fees, levies, charges with names nobody remembers. The government still gets paid. The bill simply arrives through a different door. Imagine buying groceries, buying fuel, buying electronics, buying almost anything. If income tax disappears but sales taxes rise dramatically, people start paying indirectly. Some may even end up paying more than before, especially lower income households, because wealthy people can save money. Poorer households spend a larger share of what they earn, which means consumption taxes often hit differently. The tax collector hasn't disappeared. He's just changed clothes. And that's where the debate becomes fascinating. Supporters of zero income tax argue something important. If workers keep more of their earnings, incentives improve. People work harder. Businesses invest more. Entrepreneurs take more risks. Economic activity expands. There is some logic here. When rewards increase, behavior often changes. But then comes a question economists have argued about for decades. How much? Would people work significantly more? Or only a little more? Because if government revenue falls by hundreds of billions but economic growth only rises modestly, the math still doesn't balance. And economies run on math, not slogans, Then there's another twist. Australia isn't just any economy. Australia sits on enormous natural resources: iron ore, coal, natural gas, minerals. Some supporters of tax-free income systems point to a tempting idea. What if resource wealth funded everything? After all, the country extracts billions of dollars worth of resources every year. Why tax workers when the ground itself is valuable? Interesting idea. But resource markets are volatile. Commodity prices rise. Commodity prices fall. Boom. Bust. Repeat. Building an entire government budget around unpredictable global demand can feel like building a house on shifting sand. It works beautifully. Until it doesn't, and history is full of countries that learned that lesson the hard way. Then we reach housing, because in Australia, housing is never far from any economic conversation. Imagine workers suddenly keeping much more money. Sounds fantastic. Until millions of people have more purchasing power at the same time. What happens? More buyers chase the same homes. Prices climb. Again, some of the extra income may simply flow into higher asset prices, houses, shares, investments. The extra money doesn't disappear. It goes somewhere, and where it goes determines who benefits most. This is one of the strangest truths in economics. Giving people more money doesn't automatically make everything more affordable. Sometimes it just changes the price tags. Then there's international competition. Imagine Australia becomes one of the few developed countries with zero income tax. Suddenly, the country becomes attractive. Skilled workers arrive. Entrepreneurs arrive. Investors arrive. Capital flows in. Talent flows in. That sounds fantastic. And in many ways, it would be. But rapid growth creates pressure too. Housing demand rises. Infrastructure demand rises. Public service demand rises. The very success of the policy can create new costs. More people require more services, which requires more funding, which brings us back to the same question. Who pays? The funny thing about economics is that problems rarely disappear. They usually move. Remove one pressure, another appears. Close one hole, another opens. And that's why the phrase, no income tax, is far more complicated than it sounds. Because the real question isn't whether people would like keeping more money. Of course they would. The real question is what replaces the system that's currently there. Every economic system collects resources somehow. The only difference is where. Income, consumption, property, resources, debt. Money must come from somewhere. The debate is really about choosing the least damaging option, not discovering a magical option with no trade-offs. And that's where the fantasy begins colliding with reality. Because if Australia abolished income tax tomorrow, some people would become significantly better off. Some industries would likely boom. Investment could increase. Growth could accelerate. But new taxes might appear. Public services might shrink. Housing pressures could intensify. Inequality could widen. Or perhaps the economy becomes more dynamic and prosperous than expected. Nobody knows with certainty, because economics is not physics. There is no laboratory version of Australia where we can run the experiment twice. Only trade-offs. Only probabilities. Only consequences. Which leaves us with a question that economists, politicians, and voters would spend years arguing over. If Australians could keep every dollar they earn, but had to pay for that decision somewhere else, would they actually be richer